When we're putting our money somewhere and we don't understand it, we've got to stop calling that investing. Speculation or gambling is when we put money into something that we have no idea. Why would it work? When would it work? How would it work? How does it benefit us? What are the risks involved with it? And if there's no risk management, then it's speculation. These faulty notions have rigged the game against people. They rig the game against people because first, we neglect cash flow. Second, we take on unnecessary risk that we don't understand the nature of that risk until we have a crisis like we're in today. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Garrett, Gunderson, Ask the Money Nerds. I've got Chief of Staff Stolba here, and what we're talking about today is there's times where people are really worried about liquidating things because what are the tax ramifications? Or when is the right time to sell? I mean, these are questions that I think are on the top of people's minds. So let's go to the question.
Okay, let's dive in. I do love these conversations because we're giving practical solutions for people who are really feeling distress, especially around their portfolios.
Being that most of your bonuses are tied to me being on the road speaking, this is half of your compensation right now is this education that you get, Stolba.
I guess so.
Hopefully it's worth something to you.
Fingers crossed. All right. So Michelle is the one who wrote in today. And she says, a few years ago, I inherited a stock portfolio that has a total value of approximately $300,000. Okay. I don't understand the stock market, nor do I trust it. Welcome to the club, Michelle. As a retiree.
You distrust it more than not trust it. You know enough now being around me. You're fired up. You're calling your family.
I am. I've been trying to educate everybody I know, and they're just like, well, it's low, so I think I'm just going to buy more. And I'm just like, if someone would have just listened to me a few months ago because of what I've learned from you would have been in a better position.
At the top of my lungs. It was October of 2019 where I was like, where we hosted a virtual trend summit. We were calling it. I said I was retiring at the end of 2020.
Yeah.
If I was wrong. That's how much of a stake I was putting on it. I was on Fox News with Neil Cavuto, August of 2008, saying the stock market's overvalued. Stop funding your retirement. It's time to move to cash. And people thought I was nuts. And within the next 2 weeks, there was a 14% drop. And then it just went down for 2 more. I don't know how to predict all this. Let me be clear. I didn't know that real estate market was going to dive as fast as it did in 2008. I thought it was overvalued. But when lending changes, it happens quickly. When a coronavirus happens, things happen quicker than you can predict, even if you have the most brilliant minds on things.
And even what I'm realizing as I continue to learn about all of this is there are so many variables and you don't know what is going to trigger the downturn.
Right.
And it could just be based upon an emotion or a perception. Like, I fear something's going to happen. So then people panic and make decisions, and there's a massive impact on the stock market.
I read this report one of my mentors sent me. It was from McKenzie Big Consulting Group. And they were flat out, I don't know how many years ago it was, but they were saying, we are in for something massive and major on a global scale. It's coming our way. We don't know what it is, but based upon all our models and what we've seen with the history, and I was like, wow, it kind of sounds like sky is falling, but these guys are doing research behind it, and here we are.
Yeah.
Here we are. All right.
Okay, and here we are to answer questions. Okay, so I'm going to start over from the beginning of our question so we catch it all. So Michelle says, a few years ago, I inherited a stock portfolio that has a total value of approximately $300,000. I don't understand the stock market, nor do I trust it. As a retiree living in Southern California, I'm afraid if I pull out all of the money out of the stock market, the tax implication would be worse than keeping it in there. I'm looking for a financial strategist to help me, but in the meantime, do you have any advice that can help me?
I'll go straight to the camera on this one. One, you can go to wealthfactory.com/private if you're looking for a wealth strategist. We have investment advisors, wealth strategists that you could meet. Number two, when we inherit money, there's something called a step up in basis. So capital gain assets like businesses, stocks, pieces of real estate, that can actually transfer and get a step up. So let's say this person that died paid $100,000 for these, and now they're worth $300,000. That's $200,000 of gain. But when it passes on, a lot of times there could be that step up in basis, which acts like $300,000 is what it was paid for. So that would mean that there might not be tax implications, especially with this downturn. It depends on what amount she inherited versus what it's worth right now. So you've got to learn about the step up in basis. Okay. So that's the first piece. I'll let you. Is there anything you have?
No, I don't.
I'm a master interrupter. People tell me all the time. So I'm giving you space. You always have really good insights.
Thank you.
The second piece to this is when we're putting our money somewhere and we don't understand it, we've got to stop calling that investing. The world has marketed to us, whether it's Wall Street or retirement planners, the word investing, and it's first off been collapsed to count savings and investing in the same thing. Savings is we've got money set aside. It's available. It's not earning a high interest rate. It doesn't go down, but it's not going to go up a lot. That's savings. Investing is we're locking it away potentially. It could be volatile. It might have a bigger payoff in the future. There might be certain risks associated with it. But speculation or gambling is when we put money into something that we have no idea. Why would it work? When would it work? How would it work? How does it benefit us? What are the risks involved with it? And if there's no risk management, then it's speculation. And look, institutions do a lot of risk management. Like, first off, if you go get a loan from a bank, they want a down payment. That's risk management. They want an appraisal. That's risk management. They want to see your taxes and your credit score. They want to charge you private mortgage insurance if you don't put enough down payment. They want a lot of information to protect them on the downside. So that way, if you default, they know what the underlying asset is. If you've got a down payment, you've got more skin in the game. If you show that you've had a history of a certain income or a responsibility with your credit score, these are all factors that are risk management. And look, in Wall Street, this is what frustrates me. Interest rates are 0% with the Fed right now. And so now banks can borrow super cheap to nothing, and then they can still lend it out and earn an interest, right? But if they fail like they did in 2008, right, guess who bails them out, Stolba?
You and I,
and
the rest of the public.
So this is bullshit when people say it takes money to make money. Whose money does it take? Does it really, is it the bank's money? No. They have our money that they're recycling out. Exactly. Good word. And then they say high risk equals high return. When we put money in a retirement plan that we think we're taking high risk with growth funds, the person that's the manager, they have responsibilities, but they're getting paid a fee. The company that's issuing them the talent, they're getting paid a fee on the entire portfolio, not on the cash that they put in, but on the portfolio. And if you lose, they still get a fee on whatever is left over. They're not taking high risk to get high return. It's not taking their money to make money. And yet these faulty notions have rigged the game against people. They rig the game against people because first, we neglect cash flow. Second, we take on unnecessary risk that we don't understand the nature of that risk until we have a crisis like we're in today. And then it just frustrates and creates bitterness, right? We have people that have high interest rate loans, yet they're funding their 401ks. Pay off those loans. We have people that are funding 401ks and retirement plans before they've even put 3 to 6 months of their own personal savings, or before they've invested to figure out their own skill sets. This is what's frustrating. Now, this question about inheriting, like, I love that she's just willing to admit, like, I don't know what I'm doing. I don't trust the stock market. Great. Yeah. Then it's time to figure out where you're going to invest. You've got to learn your investor DNA and understand, what do you understand? Some people are great at real estate. Some people are terrible. A few people are good at stocks. Most people are terrible. Some people are good at businesses. Others are terrible. So if you don't know to invest, I think you got to look at things more like cash flow banking that have security and stability. Yeah. And you got to look for things that have more fixed interest or fixed income, which unfortunately with interest rates so low isn't really exciting. It's not really great, but it's better than losing. Yeah. And it's better than losing sleep. And it's better than feeling this frustration. So first, she might not have a tax issue, right? And second, if you know you're gambling, it's time to move towards investing or saving. Yeah. That's the main advice.
Now, we know that she's a retiree, but we don't know if she's close to 59 and a half or she's older than 59 and a half. How does that change her circumstance?
Yeah, and I don't know if it's in a retirement plan or just inherited the stocks. If it's in a retirement plan, we might have a little bit different situation here from a tax perspective.
Yeah, good clarification.
Right? Which those taxes might have been paid upon inheritance, or it could be through what's known as a stretch IRA, which might mean that the taxes are yet to be paid until they're redeemed. Yeah. Or if it was just actual stocks, that's where that step up in basis can occur. So, I think wealthfactory.com/private is probably the best advice I can give at this point.
Okay.
All right.
Sounds good.
So asksomeonyournotes.com, ask your questions. The more details you give, the better answers I can return.